Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about inflation, and I did a video last week talking about annuities, and a lot of you reached out and said, look, Adam, if annuities don't make sense, where do I put my money where it's safe, not tied to the stock market, that I can actually get a bit of a return and hopefully keep up with inflation? So inflation, depending on what article you read and where you get your data from, right now it's floating between 4 and probably 5, maybe up to 6%. If you've visited the pumps over the past weekend, you're paying over $2. In BC here, we're paying over $2 per liter for gas. Out east, I know it's the same thing for you guys in Ontario and further east. So there's a lot going on around the world that's creating this issue. Obviously, COVID started it, supply chain issues. Now with the Russia-Ukraine, that's hurting it too with oil, fuel supply. I don't think we're going to see this come down for quite some time. And when I say that, I mean probably 1 to 3 years. We're going to see high inflation. But we've been here before, and I think that's what we start to forget. If we look back to the late 70s through to the early 90s, we were at a very high inflation rate. 1986 to 1991, so it's floating around where we are right now, which is that 4 to 6 mark. Now, if we take our average inflation rate from 1986 to 2021, you'll see that yes, we had those early years of high inflation rate, but it leveled down and it leveled out at 2.27% average, not 4, 5, 6, 7%. All of you that lived through, most of you watching this video would have, that lived through the late 70s, 80s, early 90s when inflation was really high, when you could go to the bank and get a GIC or a savings account at 15, 18%. The backside of that is a lot of you watching this video had mortgages at that point. And although housing prices were a lot less, you were paying 15 to 22% on your mortgages. Well, now fast forward, you're retiring, you have assets, you need kind of that guaranteed steady income stream, and you're getting 1.5% on your savings account. So it's kind of inverse of what you want ideally. You paid high over here when you had the debt, and now you have the asset and you're getting very little. And I know that's frustrating. I've talked to a lot of you about that. And maybe, my generation and one after mine, maybe we get lower interest rates for our mortgage, but a higher savings rate when we retire. And hopefully that's the way it goes. But we don't know. When we build out our financial plans for clients, we will mark the inflation rate at 2%. And is that realistic right now? No, we're definitely in a short period of time where it's higher, but we also might be in a period of time where it's lower too. We don't know. No one has that crystal ball. But I think we have to plan off historically what's happened and what kind of world we're living in right now. So as we move forward, how do we keep up with inflation? As you know, let's call inflation 4% right now. If you go to the bank, an online bank, wherever it is, and look for a savings account, you're looking at on its top end, maybe 1.25%. I know EQ Bank, that's what I use personally for my savings that I don't need for a little while. They're giving me 1.25%. I could lock that in for 3 or 6 months. They have a 3 or 6 month GIC right now at 2.05%, and get a 1-year GIC at 2.1, and get a 3-year rate at 3%. But here's the thing, and I think this is important. I don't think you want to lock in on a long-term GIC right now to try and keep up with inflation. I think that's backwards thinking. I think we're at a point in time, and my recommendation as a financial planner to you as a viewer would be get the best rate you can, but don't lock in too long. Interest rates are starting to rise. We saw it last week. They rose up a little bit. They will continue to tick up. So you're probably better locking into a 3, 6, or maybe even a 1-year GIC. If you kind of have that money, you don't need it, you kind of want to lock it away and get as close to inflation as you can, I would not lock that money in for more than 1 year. Because in 6 months or 12 months from now, your 3-year GIC might not be 3%, it might be closer to 4%. There's nothing out there that's going to guarantee you 4 or 5%. And if someone's telling you they're going to guarantee you 4 or 5% or even higher, take it with a grain of salt. It's not out there. We've done our research, so be aware of that. If you're someone with lots of patience and lots of time on their hand, most banks and financial institutions will throw out promotional rates. So if you bring money to them, they'll give you a higher rate for 3 or 6 months. But typically, if EQ Bank's offering, let's say 1.25, I think it's Scotia or CIBC right now has 1.75, but it's on like a 3-month term. So if you're the type that doesn't mind, jumping around and getting the highest rate, that's an option. I'm the type to just say, look, I'd rather go 1.25 and put very little effort into it. But if you're the type that wants to put in a lot of effort, you can definitely shop around and move your money around to get the best rate possible. If you're in the market for a GIC, one website I've used previously, I was actually an advisor on this website years ago, not anymore, but I know some advisors that they do a great job, but GIC Direct, you can shop the best GIC rates in your area. So you put in your information in your area, what you're looking to do, how much you're looking to invest, and it will give you the best rates in your area on different financial institutions. If you're looking just for the best savings rates out there, I personally use Rate Hub. All their links are basically affiliate links. So if you click on them, they get paid, for referring you into whatever EQ Bank or Wealthsimple or whatever you're clicking on. So be aware of that, but at least you can kind of go there and look at rates. And then if you don't want to click on their affiliate links, you can jump out and then do your own research from there. So there's Money Sense, NerdWallet, and Greedy Rates. There's others out there as well. If you have a website that you use to find the best rates that I'm not mentioning, leave a comment below. We'd love to hear what you use on your end. Now, there is one investment that I would look into if I was you. If you're looking kind of for safe, steady Eddie. Now, again, this is not a savings account or a GIC. This has the potential to lose your money. Has it ever? No. But it has the potential. And what I'm talking about here is a MIC, a Mortgage Investment Corporation. And we refer clients to one out here in BC, out in Fort Langley, called Antrim. So basically, they take investors' money and then they lend it out in first and second position mortgages. They do about 75% first position mortgages, 25% second position mortgages. Their rate of return has been consistently between 5 and 6% for many years. If we go back to 2008, 9.69% in 2008. So as you can see, they don't follow the market. They don't follow the stock market. They're not tied to the stock market. They're investing in mortgages. So as interest rates have gone down, their return has gone down. Like I said, in 2008, 9.69. Last year, they did 5.29. But as interest rates start to go up, in theory, their rate of return should go up a bit too. So if you're looking for more of a consistent 5-6% rate of return, something that's not tied to the stock markets, a mortgage investment corporation might be a good option for you. Again, I'm not saying it's a good investment for everyone. Do your due diligence. My job as a financial planner is to bring these things to your plate. You need to do the due diligence on your side to see if it's a good fit. This isn't a good fit for everyone. If you reach out to Antrim, they'll send you a brochure, it talks a bit about what they do. And right on that brochure, they talk about this isn't for 100% of your portfolio. In a perfect curve, and they've done the research on this, it's about 15%. If you put about 15% of your investment into an investment like Antrim, it can actually create less risk in your portfolio and actually a better return. There's many MICs out there. BC, Ontario are kind of the two main hubs. BC is very popular for MICs. I've known a lot of MICs that go bankrupt, that get tied up for a few years. In fact, we had a family member in a MIC that was invested, and one of the properties in the MIC went sideways. So the MIC kind of reached a bit to get a bit of a better return for their clients. That investment went sideways, and essentially for a year and a half, almost 2 years, investors couldn't pull their money out. Now, that's a huge issue. And then fast forward, once it was all cleared up, basically everyone got back about 75 cents on the dollar. So these things can happen to these MICs. So be aware of what you're getting into. Again, Antrim's one that I've kind of done some research on and I like personally for myself, but that doesn't mean it's the right one for you. Just to wrap this up, I think at the end of the day, for the majority of you watching these videos, I think you have to come to a comfort level of short term, I'm not going to keep my savings up with the inflation. Inflation's at 4, the best I can get is 1 to 2% on savings. That's just the reality. Now, inflation will peel back and hopefully interest rates will jump up. So it should kind of bob back that way. But it's definitely a very challenging time right now. I think a lot of you are losing too much sleep over it. I know it hurts your portfolio, it hurts your retirement plan. If you need to, create a financial retirement plan that shows a 4 or 5% inflation for a period of time and see what the stress test is on your retirement plan. That would be one way to go around this, just to have a mental picture on, okay, I can deal with a 3 or 4% inflation rate long term. My money won't run out, or I need to get X amount rate of return. Do these stress tests within your retirement portfolio to see how long you can handle this inflation rate with a 2% rate of return on your investments. It may not be sustainable for that long for a lot of you. So do your due diligence, do your homework, and make sure you find the best possible solution kind of within your investment risk. So thanks so much for joining us in this video. Really appreciate you viewing. If you haven't subscribed to the channel, please hit the subscribe button below. And if you like these videos, hit the thumbs up. It really does help get these out and hit the YouTube algorithm, get it to more people. So thank you. We'll see you in the next one.